Hi, my name's Ian Murray-Jones. I'm one of the in-house tax writers at Thomson Reuters. Welcome to the first in a series of videos focusing on key topics in superannuation. Now let's face it, super and its related tax issues keep on getting more and more complicated. There were changes last year which added more complexity and yet again changed the game rules. This video, specially prepared for Cleardocs customers, looks at how you can help clients build up their super balance in this changing environment. In terms of today's session, there were three key changes from last year that you need to keep in mind. I've put them up on the slide. First up, a $1.6 million pension transfer balance cap was implemented. This limits the amount that can be transferred into what is termed the retirement phase of super. Earnings on assets in retirement phase are not subject to tax. Second, there is an annual cap on non-concessional contributions of $100,000 or $300,000 over 3 years. Third, there is a prohibition on making further non-concessional contributions if the individual's total superannuation balance is $1.6 million or more as at 30 June of the previous year. Now, there are a couple of important observations to make about these changes before we get on to some number crunching. I've put them up on the slide. By the way, please don't forget that you can pause the video to read what's on the slide and then resume it to hear what I say about it. I know that this is stating the obvious, but this session covers quite a bit of ground and perhaps it could be a handy reminder. Okay, observation one. You can have more in your fund than $1.6 million. There is no limit on the total superannuation balance, but you can only have $1.6 million in pension phase when no tax is paid on earnings. This means that amounts in excess of $1.6 million must remain in accumulation phase where earnings are taxed at 15%. As you know, the marginal rate for high worth clients will be much greater than 15%. So the 15% rate is very attractive, not only to high wealth clients, but actually any SMSF. But remember, if the total superannuation balance is greater than $1.6 million, then no more non-concessional contributions. So, how do you get money into the fund to take advantage of the 15% rate? The key is being able to take advantage of various exclusions from the definition of non-concessional contributions. So, a quick summary of where we're at. There is a limit on non-concessional contributions of $100,000 per annum, and none may be made if total super exceeds $1.6 million. However, this does not apply to excluded non-concessional contributions. This can all sound a bit tricky, but it will become clearer with the following slides. I have listed four important exclusions. First are contributions arising from the disposal of business assets that qualify for the CGT Small Business 15-year exemption. This is up to a limit of $1.48 million. Second, contributions from amounts that qualify for the CGT Small Business Retirement exemption. This is up to a limit of $500,000. Third, contributions arising from structured settlements or court orders for certain personal injuries. I'm not paying any attention to this today, but it may be relevant for some of your clients. Fourth and finally, and this will be one that has widespread implications, I think, contributions from the proceeds of selling a home held for at least 10 years by a person aged 65 or over. A contribution of up to $300,000 is allowed. Now, a very important reminder. Each of these exclusions must meet their own specific rules and require good planning to qualify as excluded non-concessional contributions. For example, just because someone sells a house, don't just assume that they can contribute $300,000 to super. Although an excluded non-concessional contribution is not counted towards the $100,000 cap, it is still counted as part of a member's total superannuation balance. What does this mean? Well, it means that you should make a non-concessional contribution before you make an excluded non-concessional contribution. Again, this will make more sense when you see the following examples. In the first example on the slide, Max kept his super balance to just below $1.6 million as at 30 June 2018. he makes a non-concessional contribution of $100,000 on 1 July. He then later contributes $1.48 million from selling assets that qualify for the CGT 15-year exemption. This brings his super balance up to $3.179 million. Now, if Max had instead contributed $1.48 million on 30 June 2018, then his balance would have exceeded $1.6 million as at 30 June, and he could not have then contributed a non-concessional amount of $100,000 in July. In other words, it was important that Max contributed the non-concessional contributions first. This is not what I'd call a dead set break your heart rule, but it is a good guiding principle to keep in mind. In the next example, Max instead contributes $500,000 from a capital gain under the CGT Small Business Retirement Exemption. Together with a final $100,000 non-concessional contribution, this brings his super balance up to $2.19 million. Again, it is recommended that Max contributes the $100,000 first. Finally, the next slide gives an example where downsizer contributions are made. John and Sarah are still working part-time at age 65 and sell their family home in July 2018, as all their children have left and want the money. The sale proceeds are $2.4 million. They are both able to make a contribution of $300,000 within 90 days after settlement. This is $600,000 in total. This is regardless of how much they already have in super. Assuming John's total superannuation balance is $2.5 million as at 30 June 2018, his super balance would increase to $2.8 million as a result of the downsizer contribution. Assuming Sarah's total super balance is $1.7 million, her balance increases to $2 million. I hope that these examples highlighted some of the options that are available. Any questions? Then please let our sales staff know. That concludes today's session, so we'll see you on the next video.